New Year rally, crypto market update. That phrase sounds hopeful, but here's the uncomfortable part most people are ignoring. Over the next 30 to 60 days, the same signals that usually kick off a clean January push could do the opposite, and if you miss what's happening underneath, you won't lose because price went down. You'll lose because you trusted the timing. You clicked this because you're trying to answer one question quietly, sitting in the back of your mind. Is this the reset before a real move higher, or is this where people get trapped thinking the rally already started? And the reason that matters right now is simple. If you treat January like a guarantee instead of a setup, you'll position yourself exactly where the market tends to punish impatience. Now, let me slow this down and put you directly into the situation. You're watching Bitcoin hold together. You're seeing altcoins stop bleeding. You're hearing the same phrases again: year-end rotation, January effect, new liquidity. And on the surface, none of that sounds crazy. But here's the tension. The things that usually make a New Year rally clean and powerful are showing up late, distorted, or not at all. And that changes the entire risk profile of the next move. Most people think market updates are about price. They're not. They're about pressure, and pressure is building in places that don't show up on a chart until it's too late. Let's start where the stress actually begins, not with crypto, but with jobs. Because crypto doesn't lead when confidence is high. Crypto leads when confidence is fragile and pretending everything is fine. The latest employment numbers look okay if you glance at them. Jobs were added. The headline didn't scream recession, but when you look closer, the unemployment rate moved higher. That split matters more than most people realize. It tells you hiring isn't absorbing people the way it used to. It's a labor market that looks solid until you ask it to do one more thing. Here's why that's dangerous. When employment slows quietly, markets don't panic. They drift. They chop. They exhaust people emotionally. And that exhaustion is exactly what you're feeling right now if you've been holding through this year. Since spring, job growth hasn't accelerated. Wages aren't pushing higher. The number of people actively unemployed is higher than last year. That's not collapse, it's decay. And decay creates a specific kind of market behavior, one where rallies fade faster than expected and dips don't bounce with conviction. This is where the Federal Reserve gets pulled into the story, because the Fed is reacting to data that keeps changing character. Powell already admitted earlier employment data overstated strength. That's not a small statement. That's the central bank saying the foundation might be thinner than advertised. At the same time, he's warning markets not to overreact to short-term distortions. So what do you get? A market stuck between fear and denial. And that's why December didn't give you the calm melt-up people were hoping for. Now here's the part most investors miss. When the market can't decide if things are strong or weak, capital hides. It doesn't leave all at once. It clusters. And you can see that clearly in equities right now, 7 stocks. That's it. Roughly 7 names are carrying over a quarter of the S&P 500's earnings. Think about that for a second. A massive index, global exposure, and yet profits are resting on a handful of shoulders. That's not healthy. That's concentrated stability. And concentrated stability feels safe right until it cracks. If that sounds familiar, it should. Crypto has been doing the exact same thing. Capital crowded into Bitcoin, then a few majors. Liquidity drained everywhere else. It wasn't a crash, it was neglect. And neglect is how markets quietly set traps. Here's where the New Year rally narrative starts to wobble. A real durable rally needs participation. It needs breadth. It needs risk appetite that spreads, not hides. Right now, what you have is money looking for shelter, not opportunity. That doesn't mean price can't go up. It means the path up is narrower and more fragile than headlines suggest. Now let's talk about volatility, because this is where 2026 starts to leak into the present. There's an argument gaining traction that next year won't be a straight line in either direction. Instead, it's likely to be a series of deep pullbacks followed by recoveries that leave the market higher overall. That sounds optimistic, but it comes with a cost. Those pullbacks aren't gentle. 10 to 20% moves reset positioning. They force people out. They make you question your thesis, even if nothing structurally broke. And here's the key tension. The market doesn't need bad news for that to happen. It just needs uncertainty plus leverage. Now bring crypto back into this. Earlier this cycle, crypto absorbed a shock that rivaled the worst moments of the last bear market: forced liquidations, structural stress, confidence damage. Historically, it takes about 8 weeks for crypto to clear that kind of leverage and find its footing again. We're past that window now, and that's why you're seeing cautious optimism creep back in. Some are even saying Bitcoin could double in a matter of weeks. That's the kind of statement that grabs attention. And it should, because if Bitcoin were to decisively break and hold above 6 figures, it wouldn't just be another rally. It would challenge the entire 4-year cycle model people lean on. But here's where timing matters. When you zoom out to monthly data, liquidity is no longer rushing in. It's easing out, slowly, quietly. That doesn't scream crash, but it does warn you not to confuse relief with strength. Monthly momentum moves like a glacier. When it shifts, it matters. And the first sustained signs of liquidity leaving since the last peak are showing up now. That doesn't kill the long-term case for Bitcoin. It just raises the bar for patience and positioning. And this is where a lot of investors get uncomfortable, because narratives are comforting, timing is not. Regulation was supposed to help here, clear rules, market structure, institutional confidence. But deadlines slipped, politics took over, crypto dropped down the priority list again. Even if legislation moves forward next year, it won't be clean. It won't be fast. It will be amended, diluted, debated, and markets don't wait politely for clarity. They price the delay. Prediction markets are already reflecting this hesitation. Government funding risks, policy uncertainty, all of it feeds into sentiment whether you trade it or not. Now add one more layer: stimulus, tax refunds. There's talk of meaningful cash hitting households again. On paper, that looks bullish. Hundreds of billions entering the system. But here's the question that actually matters. Where does that money go? The last time this happened, people were eager to speculate. Today, households are cautious. Rent is higher. Food costs more. Debt is heavier. That changes behavior. Not all liquidity is risk-seeking liquidity. Some of it just fills holes. Now we need to talk about the force that's quietly reshaping everything underneath this entire cycle. And, I mean, underneath markets, underneath narratives, underneath even how people think about work and value. Artificial intelligence. Most people talk about AI like it's just another productivity upgrade. Faster software, smarter tools, better efficiency. Something you bolt onto existing systems and move on. And yes, that layer is real. AI is boosting productivity across industries right now in very visible ways. Tasks that used to take hours are getting done in minutes. Research, analysis, design, customer support, coding, even decision-making workflows are being compressed into shorter and shorter timeframes. Roles that once required entire teams are now being handled by a handful of people working alongside systems, in some cases by one person. That alone reshapes margins. It changes cost structures. It changes how quickly companies can move, how aggressively they can compete, and how much pressure they can put on rivals that are slower to adapt. If you're an investor, that's the easy part to see. Higher productivity can mean higher earnings. Lower costs can mean better margins. And better margins usually justify higher valuations. But that's only the surface layer of what's happening. The deeper shift is more uncomfortable, and it's happening faster than most people expected. AI isn't just making workers more efficient. It's replacing certain types of labor outright. Not with announcements, not with mass layoffs all at once, quietly and unevenly. White-collar work that used to feel insulated is now exposed, not because people aren't capable, but because systems are getting good enough to handle repeatable cognitive tasks at scale. Things like drafting, reviewing, summarizing, modeling, routing decisions, and even managing other tools. And this creates a strange contradiction in the data that keeps confusing markets. Productivity goes up, output per worker increases, corporate profits hold up, but employment growth slows. Wage pressure eases, hiring freezes spread without headlines. Confidence starts to fracture. even though top-line numbers don't immediately collapse. That's why you can have an economy that looks resilient on paper and fragile underneath. And markets struggle to price that correctly, because this isn't a traditional slowdown driven by demand falling off a cliff. It's a transition where technology is absorbing growth that would have previously shown up as jobs, and that makes timing incredibly hard. Now here's the part that really matters for markets, and especially for how this cycle unfolds. Unlike older technologies that tended to get cheaper, simpler, and more commoditized over time, AI systems can actually increase in value as they scale. The more data they touch, the more feedback they receive. The more integrated they become into workflows, the harder they are to replace. Once an AI system is embedded deeply enough, it stops being a tool and starts becoming infrastructure. That changes competitive dynamics completely. Early winners don't just get ahead, they pull away. They attract more data, more users, more capital. That reinforces their advantage. And before you realize it, you're looking at winner take most outcomes instead of competitive balance. That's incredibly bullish for the companies that genuinely win that race. But it's also where risk quietly concentrates, because when markets recognize this dynamic, they tend to price it everywhere at once. Investors start assuming that multiple companies will all emerge as dominant winners. Valuations stretch, expectations harden, and the gap between what needs to go right and what can go wrong widens. At that point, AI stops being just a growth story and becomes a fragility story too. If adoption slows even slightly, if regulation interferes, if margins disappoint, or if competition compresses pricing, the downside can be sharp. Not because the technology failed, but because the expectations were built on perfection. And that tension is exactly what's feeding into broader market uncertainty right now. That's incredibly bullish for the companies that truly win, and incredibly dangerous for everything priced as if it will. Markets have a habit of extrapolating success far too early. Once a theme proves real, investors rush to price perfection everywhere. Every company becomes an AI company. Every balance sheet gets a future premium attached to it. And that's when expectations quietly become the risk. High expectations compress future returns. When a stock or a sector or an entire narrative is priced as if success is guaranteed, there's no margin for error left. Execution has to be flawless. Growth has to be uninterrupted. Any slowdown, even a temporary one, turns into disappointment. That's how you end up with situations where the technology is clearly transformative, yet investors still lose money. We've seen this before. The internet changed everything: communication, commerce, culture, productivity. It reshaped the world. And yet, most dot-com stocks didn't survive. Not because the internet failed, because valuations ran ahead of reality. Capital crowded into ideas before business models matured. AI is walking a similar line right now. It's real, it's powerful, it's not going away. But that doesn't mean every company exposed to it will reward investors. And crypto works the exact same way. The underlying technology can succeed while most tokens don't. Blockchain can reshape financial rails, settlement, ownership, coordination, and still leave behind a graveyard of projects that never mattered. That's why it's so dangerous to confuse being early with being right. Only a small percentage of altcoins will matter long term, maybe 5 to 10% if that. But those few can define entire cycles. They can create outsized returns that skew performance and narratives for years. The problem isn't identifying that possibility. The problem is surviving long enough to benefit from it. Most people don't lose because they picked the wrong idea. They lose because volatility forces them out before the thesis ever plays out. They underestimate how long it takes, how uncomfortable it feels, how many false starts happen along the way. That's why discipline beats prediction. Prediction feels powerful, discipline feels boring, but discipline is what keeps you in the game when timing refuses to cooperate. Now layer that onto what's happening with rates and policy. The Federal Reserve has already cut rates aggressively, multiple cuts, a meaningful shift, and yet long-term yields remain stubborn. In fact, markets are pricing higher rates further down the road than they were before easing even began. That's not a coincidence. That's a signal. It tells you confidence in the path forward is shaky. Investors aren't convinced that cuts alone solve the underlying issues. Growth, inflation, productivity, labor displacement, fiscal stress. None of those disappear because rates move lower. And then you add leadership uncertainty at the Fed, potential changes, different tones, different philosophies. That matters more than people like to admit. Markets don't just react to policy, they react to credibility, to consistency, to communication. A calm, trusted voice can stabilize expectations. A confusing one can amplify volatility, even if the policy itself doesn't change. So when you strip all of that together, the question becomes unavoidable. So where does that actually leave you right now? Honestly, if you strip away the noise and the narratives, you're not broken, you're not euphoric, you're stressed. And that stress isn't because you lack conviction or intelligence. It's because you're operating inside one of the hardest market environments to stay disciplined in. Crypto right now is doing what it almost always does before a bigger decision gets made. It's acting as an early signal for risk appetite. And that signal isn't screaming collapse. It's not flashing green either. It's cautious, careful, hesitant. That middle ground is brutal because fear gives you clarity. You know what fear feels like. Euphoria gives you momentum. You know what euphoria feels like. Caution sits in between and slowly drains you. Price moves just enough to keep you engaged. Headlines shift just enough to keep you uncertain. Every small rally makes you wonder if this is the one you'll regret missing. Every pullback makes you question whether patience is actually just denial. That's why this phase feels heavier than it looks. Bear markets are brutal, but they're honest. They tell you exactly where you stand. Euphoria is dangerous, but it feels good while it lasts. Caution gives you neither. It keeps you awake. It keeps you second-guessing. It makes every decision feel urgent even when nothing has resolved yet. And understanding the emotional landscape matters just as much as understanding charts or macro data. Because this is the phase where discipline quietly determines who's still around when the real move finally arrives. That's why this phase feels exhausting. Cautious markets don't give you clean signals. They don't give you confidence, they give you false starts. One breakout that fails. One dip that doesn't quite bounce. Chop that looks meaningless day to day, but adds up emotionally over weeks. And here's the part that matters more than any chart. This is exactly when people abandon good plans for bad timing. Not because they're greedy, because they're tired, because uncertainty feels worse than being wrong. You start thinking maybe you missed it, or maybe you're late, or maybe you should just do something, anything, to feel back in control again. That's when people who were patient all year suddenly chase a move they don't fully believe in, or panic out of positions they spent months building. And none of that shows up as a mistake in the moment. It only becomes obvious later. This might shock you, but I'm not a financial advisor and nothing in this video is financial advice. Cryptocurrencies are highly volatile and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses, and this video is for entertainment and educational purposes only. Now here's the reframe that actually matters, and this is where most people get it wrong every single year. A New Year rally doesn't fail because price doesn't go up. It fails because people expect it to be easy. They expect January to fix December. They expect fresh calendars to reset risk. They expect liquidity to show up on schedule and reward anyone who positioned early. And sometimes that happens. But when it doesn't, frustration builds fast. The real opportunity in the coming months isn't about catching the fastest move or being the most aggressive. It's about managing exposure while other people chase certainty that doesn't exist yet. That means knowing when not to press. Knowing when holding is a decision, not a lack of one. Knowing when the smartest move is letting the market show its hand instead of forcing yours. That's not exciting, but it's effective. This is where education matters more than excitement, because excitement pushes you toward narratives. Education pulls you back toward structure, toward cycles, toward understanding why certain phases feel the way they do. Over time, communities that focus on psychology and market structure outperform hype-driven groups, not because they predict better, but because they survive longer. They don't need to be right every time. They just need to avoid being wrong at the worst possible moment. That's also why places like Cheeky School exist. Not to promise returns, not to sell certainty, but to help you think clearly when markets are loud, confusing, and emotionally draining. Because the next phase isn't about calling the exact top or bottom. It's about staying flexible while pressure builds. About keeping optionality instead of locking yourself into one outcome. If you can do that, volatility stops being something that happens to you. It becomes something you work with, something you respect instead of fear. And that shift, more than any rally, is what actually compounds over time. Subscribe or watch the next video.